Yeah, Abhishek, my index funds have gone down by 10%.
This is what happened. Everything else will save you, no? Your gold price is going up. Bet me will get 7% returns. It's fine.
This is everything.
This is what? सारा पैसा equity में डाल दिया? Are you crazy? अकल कहाँ है तुम्हारी? Hello, talk. Look at me. अकल कहाँ है तुम्हारी? I think है ही नहीं. You know, this time the market will not spare you. Tissue चाहिए?
Sir, this is not right.
What happened?
Abhishek is shouting at me.
Why is he shouting at you? That's not the culture we promote.
Because of you. You didn't tell me about gold and debt.
I think you're too worried about your own portfolio. Where's that plan for the Women 01 channel?
It's
The
on its
social
way.
plan. Where?
I'll show it to you
It
tomorrow.
was due last week.
I'll show it to you tomorrow if you help me with this.
So we'll talk about equity, gold and debt and how you can balance your portfolio.
Yes.
Now, we can talk about asset allocation and how you can divide your capital to cushion and reduce risk, but that will become too...
Complicated.
Yeah, correct. So, let me show you something simple, okay? So, this is Nifty in 2008. And you all know 2008 mein kya hua tha?
Crash.
Okay. Which means Nifty went
Down.
Alright. Overall, do you think Nifty has gone up?
Yeah.
So, if you invest, you'll also make money?
Yeah.
This is the biggest lie you've been told.
Why?
Because you will not be able to hold on to Nifty for so long. You will be scared and certain events will happen. Jahan lagega, "Arey dhak dhak, arey dhak dhak." I will show you another chart over here. Same time period. Did the market go up or down?
Remain the same.
This is gold.
Oh.
What do you think about gold?
Gold, is it safe? It's safer, right? Compared to equity?
Keep going.
So I've heard that usually if equity is doing well, gold is in the opposite direction. If equity falls, gold does well. So I think it balances itself.
We'll do an exercise. You guys pause the video. Write down what do you think of gold. Safe hai, ulta hota hai, markets go up, gold goes down. Whatever you think about gold, put in those keywords in the comment and hit submit. So then we have your thesis. And then we look at, with you, the data. We have gold and equity over here. These are the years 2006 all the way to 2024. The blue is gold return, so that's 20%. And the orange is Nifty, that's 40% for 2006. And when the bar goes under, that's minus. So 2008, we can see it's like, looks like minus 50% for Nifty. You have to see, when the orange bar is down, is the blue bar up? If that is true, so over here, yes or no?
No.
Over here.
No.
Here.
Yes.
Over here.
No.
Here.
No. Yes.
So were there a lot of yeses?
No.
Which means that they are not inversely correlated. So this myth of people saying when gold is down, equity will go up. When equity is up, gold will go down. This is not true.
But according to this, gold doesn't fluctuate as much as Nifty.
Why do you think so?
Like if you see here, like Nifty is going crazy up
Yeah.
and then crazy down.
Yeah.
Whereas like if you look at gold, it's been quite consistent. Rather it's just come down. What's the point of investing in gold? Like if you see here 2006 and 2024, 24 is down only. I mean, it really didn't go anywhere.
The question is actually really good. Why should you even consider gold if it doesn't give good returns?
Yeah.
Correct? What if I told you, I'm going to give you your dream salary, and this is to do with risk. So what's your dream salary? Dream! Ekdam, this is nuts. I don't deserve this.
Unrealistic.
Unrealistic.
Okay, let's go 5 crore a month.
5 crore a month. Let's change this to 7.5 crores a month. Heck, let's change it to 8 crores a month.
Okay.
What can you buy in 8 crores a month?
Everything.
Don't answer that. How much is 8 crores in 10 months? Because it's easier to calculate.
Damn it. 18. No. 80.
Okay. 80 crores. Is that a lot of money?
Yeah.
Perfect. Now let me tell you the job. Today is your first day at this job. You have to go into a coliseum.
A what?
Coliseum. I'll fly you to Rome in a coliseum. There'll be, lakhs of people looking at you, and wahan pe people will come with swords. You will also have a sword, and it's a death match to the end.
Oh, so one of us dies,
No, one person survives.
but I can die.
Yeah, there's 6 people. They have 20 years of experience each doing this,
Oh,
and
I'll
you are
die.
a football player. Would you take this job?
I won't take it. No.
Why?
Because life is more important than 80 crores.
So it is more risky, and the risk is so stupid, no amount of reward would make sense. Correct?
Yeah.
So the same thing is true over here. If your money is in the most volatile asset class, the chances of you seeing a negative return in a short period of time is very high. Now you decide, are you comfortable with it? Then fine.
Can I wait till gold to go down and then invest in it?
No, you can't time the market. I just watched this video where we explain about timing the market. You have to get a personal finance advisor who can come understand your situation, figure out aapko risk kitna hai. You cannot watch a YouTube video and figure out aapka asset allocation kya hona chahiye. This video will only tell you that asset allocation should happen. That's it. After that, it's a very personal journey. But what we can do is, we can plug this in a Excel sheet. We'll do this very simply. We have only Nifty returns. We have this 10,000 rupees invested, by the way. Then there's Nifty plus gold. There's Nifty plus gold plus debt. So over here we can see from 2004 to 2024, money is being invested. The returns don't matter. We're only focusing on the loss. When the markets fell down, how do you feel? So over here you can see the fall or rise. What's that?
Minus 31%.
How do you feel about it?
Bad.
If you go to Nifty plus gold, where you've invested some amount in gold, this is what it looks like. What is the fall?
Minus 17.
Interesting, right?
Yeah.
In this case, your notional loss was minus 17%. And in just the Nifty case, it was minus 31%. Why?
It balanced itself out.
Yeah. And basically, gold did not fall as much.
Yeah.
So over here, we've invested how much in equity?
5,000.
And how much in gold?
5,000. What is debt? Debt.
Debt is another asset class where basically, and I'm oversimplifying this, you are giving a loan to a company. The company is using that loan to expand its business, grow its business, and it's giving you a fixed return.
Like a bond?
Yeah, like a bond. It is a bond.
Oh, okay.
So you have corporate bonds, you have government bonds, state bonds, etc. And there is an interest rate that they give you called a coupon rate, and it's fixed. And you have to hold it for a period of time. So it could be a 5-year bond, a 3-year bond, a 10-year bond.
Like an FD.
Exactly like an FD. An FD is also a fixed income asset.
Okay.
But that's with a bank. All right. So over here, now what you can do is you can change this. Now, are you okay with losing 17%? Potentially.
No.
No. How much are you okay if the market had fallen 31%?
0.
0. Great. Then take your money and put it on the pillow. You have to take some risk. What risk are you comfortable with? So
10.
Yeah, so that means that how would you change this? 5,000 equity, 5,000 gold. What would you do?
Oh, should I make this 6,000?
Okay. And then equity will become?
4,000.
Yeah. Yeah, perfect. So now, once you change that, this now become 14%. Is that better?
Better.
Better. Now let's see the gains. So Nifty then goes up 60% the next year.
Nice.
What happens to your portfolio where you changed it? It's now only 23% up, not 60% up.
Damn.
How does that make you feel?
Worse.
So what do you want to do? Do you want to increase Nifty a little bit?
Yes.
Okay,
Then,
go ahead.
Oh, I can do 6,004.
6,004. Why you changing this? Just now you didn't want to lose 14%.
But then I gained way more, so.
Oh, okay. Now you make 33%, but last year you would have lost 20% in this asset allocation.
But I gained more next year.
Is it okay? Sounds okay. The same thing is available in Nifty plus gold plus debt. You can change these numbers and come to an amount. We've assumed fixed deposit as your debt, and we're calling it 6.5%. So what did you learn from this?
That I should also invest in gold and debt.
Because?
So that I can secure my returns or gains and balance them out. So equity, we know we can just get it through like a broking app or whatever. Gold also, I can just go and type gold and get it.
So on any broking app, you can actually see this. This is an exchange traded fund. So it's a fund, but it's traded on the exchange and you can buy it using a broking app. ETF can be silver, can be gold. There are multiple kinds of ETFs, but you have to look for stuff like liquidity, etc.
I just understood all of this. What is this now? Liquidity and now how do I select an ETF? What is this? This is not simple.
They can vote. You tell us what you want, what did you like, what did you not like about this video. And if you want to know more about ETFs, maybe we can make a dedicated video on it.